Whenever I look at the global financial stage, I'm reminded of that old trick magicians use. They call it misdirection. They get you to look at one hand, the one with all the flashy gestures.
While the other hand is actually doing the real work.
Exactly. And in the global economy right now, that flashy hand is China. We are all completely obsessed with Beijing. Is their property market imploding? Are they dumping bonds? We track every single headline coming out of the East.
Which makes sense. I mean, they're a superpower. But that obsession can create a huge blind spot.
A massive one. Because while we've all been staring at China, the other hand, the swing state of the global economy, has been quietly rewriting the rules, and we're talking about India.
And we are, specifically, looking at a report that came out this week. It's titled The Great Indian Unwind: Sovereignty Over the Dollar.
The title alone sounds like a thriller, but the content, it's even more gripping because it details this shift that happened late last year in 2025 that I think most people completely missed.
Yeah, it's the kind of thing that, doesn't look like much day to day, but when you zoom out, you realize the entire ground has shifted under your feet. This isn't just about money. It's about a major power fundamentally rejecting the risk-free idea of the U.S. dollar.
So our mission for this deep dive is to unpack that. We're going to look at why India just broke a 30-year habit, how they did it so quietly, and what it tells us about, well, the future of global trust.
Let's get into it.
To really get the scale of this unwind, we first have to talk about the wind, the way things used to work. For the last, 3 decades, India had a very specific playbook.
Oh, it was incredibly mechanical, almost like an algorithm. Just think about the Indian economy. They're a services giant. They export software, consulting, tech support to the West.
And they get paid for all of that in U.S. dollars.
Right. So India ends up with this huge pile of dollars from their trade surplus. For 30 years, the question, what do we do with all these dollars, had one and only one answer. You recycle them. You take those dollars and you buy U.S. Treasury bonds.
It's the great loop that powered the global economy for a generation. We buy their services, they buy our debt, it keeps our interest rates low, and it gives them a, quote, safe place to park their savings.
Safety is the key word there. It wasn't about strategy. It was just pragmatism. U.S. Treasuries were seen as the safest asset on earth. You put your money there, you earn a little interest, and, you sleep at night.
Stability over everything else. That was the whole assumption.
Until late 2025. That's when the algorithm just broke.
I was looking at the data in the report, the charts on foreign holdings of U.S. debt, and it's not a gentle slope down. It's like a cliff. In the 12 months leading up to now, January 2026, the Reserve Bank of India, the RBI, sold off roughly 20% of its U.S. Treasury holdings.
That's a huge amount of money to pull out in such a short time. We're talking over $50 billion in sovereign debt just gone.
And $50 billion isn't a rounding error, not even for a country like India. But here's the part that I just can't wrap my head around. Usually a country dumps its reserves when it's in trouble, right? When they need cash to save their own currency.
Exactly. That's the classic distress signal.
Right.
If the rupee was crashing, you'd sell dollars to buy rupees and prop it up. But that wasn't happening at all. The rupee has been stable. India's reserves are near record highs.
So they weren't desperate for the money.
Not in the slightest. They were selling from a position of strength.
And they were selling into high yields. That's the other really weird part. U.S. interest rates have been around, 4 or 5%? In any normal world, if the safest asset offers you a guaranteed 5% return, You
buy with both hands. You lock it in. That's what institutions are supposed to do.
But the RBI looked at that guaranteed return and basically said, no, thank you.
They walked away from free money.
Yeah.
And that is why this is so important. When a central bank rejects a high risk-free yield, it means they've changed their definition of risk. They aren't worried about the return on their capital. They're worried about the return of their capital.
You're saying they were worried they literally might not get their money back, or that the money itself was a trap?
I think it's the latter. They're pricing in a danger that you can't see on a spreadsheet. You have to look at the geopolitics. To understand India's move in 2025, you really have to go back to the earthquake of 2022.
The sanctions on Russia.
Specifically, the freezing of Russia's sovereign reserves by Western governments. That one move just shattered this decades-old illusion of neutrality. Before 2022, central bankers thought of treasuries as a neutral savings account. After 2022, they realized they're an IOU from a government that can be canceled if you step out of line.
So their insurance policy suddenly became leverage that could be used against them.
Precisely. If all your nation's savings are in U.S. debt, you've handed Washington a kill switch to your economy. Now think about India's position. It's complicated. They buy Russian oil, they buy French jets, they compete with China, but they also trade with them, and they partner with the U.S. on technology.
They're trying to be friends with everyone, which means they're exposed to pressure from everyone.
And in this fractured world, holding all your savings in one camp's bank account isn't neutral. It's a vulnerability. India realized that to maintain its strategic autonomy, its ability to make its own choices, it had to get out from under Washington's financial control.
But, unlike China, which is always making these loud speeches about de-dollarization, India didn't say a word.
And that's the classic Indian approach to geopolitics. It's very quiet, very deliberate, no press conferences, no threats. They just slowly, methodically started hitting the sell button.
The silent exit from the global financial system?
You got it.
Yeah.
But that leads to the next question, right? $50 billion doesn't just disappear. They sold the bonds. They had all this cash. So where did it go?
And this is where his story shifts from like a financial report to something that feels more like a spy movie. They didn't just swap it for another currency like the euro or the yen. They swapped it for metal.
Gold, a massive amount of physical gold.
But the report makes this really key distinction that I think is so important. It wasn't just buying gold. It was repatriating it.
Taking physical delivery, bringing it home.
Why does the location matter so much? I mean, gold is gold, isn't it? Whether it's sitting in a vault in London or Mumbai, the price is the same.
On a screen, yes. In the real world, no, absolutely not. And for India, this is deeply, deeply personal.
Yeah.
The report talks about a historical trauma from the 1990s.
Yeah, I saw that. The 1991 crisis. I knew it was bad, but I didn't realize how deep that scar was.
Oh, it's fundamental to how they think. In 1991, India was on the verge of default. They were almost out of foreign currency. To get an emergency loan to keep the country from collapsing, the Indian government had to physically ship its national gold reserves to London as collateral.
They had to pawn the crown jewels.
Literally. There were these famous stories of unmarked vans driving the gold to the airport in the middle of the night. It was seen as a profound national humiliation, and it created this deep-seated belief that if your gold isn't in your own vault, you're not truly sovereign.
Wow. So bringing it all back home now, it's like closing a 30-year circle, a statement.
It's a statement of strength, for sure. But in 2026, it's also about legal reality. This gets to the difference between a financial asset and a sovereign asset.
Okay, break that down for us.
When your gold is in a vault in, say, the Bank of England, it's a financial asset. It's a line on a ledger. If sanctions hit, a foreign court can freeze that asset. You have counterparty risk. You need permission to access your own property.
The counterparty being the country where the vault is located.
Exactly. But when that gold is sitting in a vault in Nagpur, guarded by the Indian military, the counterparty risk is zero. It can't be frozen or sanctioned unless someone invades the country and physically takes it.
So by moving it, they're essentially saying, we no longer trust the global legal system to protect our assets.
They're removing the permission layer, and the data shows it. Gold's share of India's total reserves has roughly doubled. They are swapping an IOU from a foreign government for physical metal they can hold in their own hands.
It's insurance against the system breaking.
That's the perfect way to phrase it. They aren't betting on the price of gold going up. They're ensuring they can operate if the global rules-based order falls apart.
Which brings us to that next section in the report on alternative plumbing. Because you don't just get all this gold to sit on it, you want to use it.
Right. The end goal here is true independence. India wants to be its own pole in a multipolar world. They want to be able to trade with Russia, with Iran, with the global south, without ever having to touch the dollar system.
Because the dollar system means SWIFT, and SWIFT is the choke point.
SWIFT is the kill switch. Get kicked off that and you're cut off from global trade. Unless, of course, you build your own pipes.
So how does gold become the pipe? It's not like they're trading gold coins for barrels of oil.
No, not like that. Think of it as the ultimate settlement layer. Let's say India buys oil from Russia. They can do the trade in their local currencies, rupees and rubles.
Okay, so I pay you in rupees, you pay me in rubles.
But over time, those trades won't balance perfectly. Russia might end up with a huge pile of rupees that it doesn't really want or trust long-term.
Ah, okay. And they need something to settle the difference.
Exactly. In the old world, you'd settle that imbalance in dollars. In this new world, you can settle it by transferring ownership of physical gold. It completely bypasses the U.S. banking system. It's the ultimate neutral asset.
So it's like a high-tech barter system.
It is. A barter system that's immune to sanctions. And the report shows that India is pouring money into this new infrastructure. It's still small, but the direction of travel is unmistakable. And here's the beautiful irony of it all.
What's that?
The money to build this new independent system, it came from selling off the assets of the old system. They sold U.S. Treasuries to fund the very thing that makes Treasuries less necessary.
Wow. That's ruthless, but brilliant.
It's pure strategy.
But this creates a huge problem for the U.S., doesn't it? We talked about that recycling loop. If India breaks it, and we already know China is backing away, who is left to buy all the new debt?
That is the trillion-dollar question. The entire U.S. fiscal situation depends on foreign demand for its debt to keep interest rates manageable. If the fastest-growing major economy in the world just says, we're out, that demand vanishes.
So who fills that gap?
The buyer of last resort, the Federal Reserve, or, domestic banks are forced to buy it.
Which means printing money, one way or another.
It means monetary expansion. If foreigners won't fund your deficit, you have to fund it yourself, which ultimately means inflation. It makes the whole U.S. system far more brittle.
And India sees that coming.
They absolutely see it coming. And I want to be crystal clear on this point, because the report is too. This is not an anti-American move. India isn't trying to crash the dollar. They love American tech, American trade.
It's a pro-India move, a pro-survival move.
Correct. They are looking at the U.S. debt situation, the politics, the inflation, and they are rationally saying, we need to move our savings away from the epicenter of the potential crisis.
They're getting out of the building before the fire starts.
They smell the smoke. And by leaving, maybe they make the fire more likely because they're removing a pillar of support, but their first duty is to their own survival, not to propping up the old system.
It's a rational actor in an increasingly, let's say, chaotic market.
It is, and it's a powerful signal. Every other emerging market is watching this. If India can pull this off without crashing its own economy, it creates a blueprint for others to follow.
Okay, so this is a massive story, but let's bring it back to the listener, to the learner. Most of us aren't running central banks. What's the real takeaway for an individual?
I think there are a couple of layers here. The first is pretty simple. Watch the whales.
Central banks being the whales.
The biggest whales in the financial ocean. And you have to remember, they're insiders. They have more data, more access than anyone. And they don't speculate, they insure. So if the people responsible for global stability are quietly moving out of paper and into hard assets, that's a signal.
They're preparing for a storm.
And you should ask yourself if you are. The second takeaway is this idea of paper claims versus physical reality. In a high-trust world, owning a gold ETF is fine. It's easy. But you just own a piece of paper that says you own gold.
But in a low-trust world...
In a low-trust world, which is exactly what India is preparing for, that paper claim can break. This mass repatriation is the loudest possible signal that trust is breaking down. So you have to ask yourself, do I own the thing? Or do I own a promise for the thing that relies on someone else to make good?
Counterparty risk. It's the hidden danger in everything.
It is. India is getting rid of this counterparty risk.
And the last point.
Just realize that the music is slowing down.
The old game of musical chairs.
It's a cliche for a reason. The whole system has been running on the assumption that the U.S. Treasury market is the only chair worth sitting in. What India is doing, what this report shows, is that the smartest players are now looking for a chair made of solid wood gold, real assets, before the music stops for good.
They're not reacting to a crisis. They're positioning themselves to avoid one.
Precisely. They sold not out of weakness, but to remove a vulnerability. And that's a lesson that applies as much to your personal finances as it does to geopolitics. Fix your roof while the sun is still shining.
It really changes how you look at the daily headlines. It's a reminder to watch what the big players do, not just what they say.
Actions will always speak louder than press releases.
Well, thank you for listening to this deep dive. Maybe go take a look at your own portfolio's sovereignty. We'll see you next time.
Take care.